Good morning, Jags. This is Fahad. Today is Tuesday, June 9th. How's everyone doing?
Doing well.
I'm good, Fahad. How's everybody else?
Good.
All right.
Okay, so a quick look in the pre-market, the equity futures, and um, judging by the movement in various indices, looks like we're going to get the rotation back into growth a little bit. Let's see how sustainable that is. What I mean by that is the Russell 2000 index is set to open down by about 1.6%, but NASDAQ is only down by 0.2%. So that's telling me that the money has been, for the last 2 weeks, has been pushing and pushing and pushing into value. And we have benefited with some of those trends as well. But at least for today, I think our growth stocks are going to take the upper lead again. Something to be mindful if you're positioning or if you're trying to play some trends. If that does happen, let's suppose if NASDAQ is showing positive signs or is holding well, there are some technical takes out there that should actually benefit all of this. So for example, just yesterday we discussed Spotify. That chart looks good. That chart could set up for a breakout. Microsoft has a very beautiful technical setup as it's starting to break out from a tight bull flag consolidation. So if you see right over here, this thing is potentially going to make its way to 190 and higher if Nasdaq outperforms and the growth value starts to if Nasdaq outperform, growth starts to move higher and value starts to take a back seat. So there's Microsoft setup, and some of those other software names could also be set up for that. So just keep in mind on the high level view. Now, with all of this said, I'm just going to touch upon a couple things that are on my watch list. Just pure, quick, small fundamental takes. The first one is Marathon Petroleum, MPC, the oil refiner. Yesterday was an absolute fabulous rally in the oil sector overall. So XOP was up 12% yesterday. Now it is hitting the 200-day moving average, which is coming down sharply, but taking a look at the VOP levels, this thing still has a bit to run all the way to $77 to $80 per share. That's XOP, and XLE was also up very nicely yesterday, about 5 or 6%, a continuation of the trend. Now, Marathon Petroleum is an oil refiner, but something that you may not know is that company gets lots of its production from the Canadian oil, which uses the type of crude called SYNA crude. And the differential between, Syncrude, SYNCRUDE. And whenever the differential between Syncrude and the spot market for WTI are showing a widening spread, that generally tends to be positive for this refiner. And we're starting to see for the last couple of days that's exactly what is emerging. In fact, as of yesterday, the Syncrude versus WTI discount widened to $3.50 per barrel. That's actual crack spreads or margins for this refiner. And Syncrude discount means that MPC uses about 450 to 500 million barrels of oil per day in the Canadian crude in its refineries, 40 to 50% of which is Syncrude. And so net, the wider the discount is, the better it is for Marathon Petroleum. Something to keep in mind: if the rally continues in the oil sector going forward from here, this oil refiner should continue to be stay positive and we should see more upside. So you can see, for example, yesterday, a lot of the WTI, and then compare that to SYNA in this website called oilprice.com, and you'll be able to actually figure out what the differential is. It's not very hard. So there's that. I'm watching MPC on any kind of pullback for potential another entry, because I think this thing has more room to run. It will probably get to $50 to $55 per barrel. $50 to $55 per share, MPC that is, after a minor pullback. So I'll be looking for any entry in this one. That's MPC. Next one is a technical view after a very positive news that came out yesterday, which was Edward Life Sciences. Edward Life Sciences has a very nice technical chart setup, and somehow we missed to cover this one yesterday. Let me get rid of these moving averages. power candle on Friday, a big bullish engulfing candle, and a very nice strong follow through yesterday. Now, I mentioned this recently that a lot of the healthcare names have not participated the way I had expected when the money was rotating out of growth into value names. But this one reported yesterday with a big PR out that the company is launching in China its TAVR, the Sapien 3 device that is very, very popular with a strong traction in North America. It has finally launched in China, and it's happening much earlier than expected. So it was not in consensus view. The approval marks a milestone for Chinese physicians and their patients living with severe AS in need of alternative to open heart surgery. And the Sapien 3 valve on the Edwards decades of experience, and it's going to be most widely used transcatheter valve with more than 30,000 patients treated in clinical trials and registries in over 65 countries. So Chinese clearly had the confidence given its highly successful Sapien 3 valve all over the world. So they finally gave the approval to this earlier than expected. And as a result, the stock hit a power candle yesterday. I did not see much of option activity to pick up on this despite this strong rally, but technically on a high volume rally like this, I think this is setting up gradually to move all the way to a new 52-week high. There's going to be a major VOP resistance that's coming up around $79, $80 per share. If it can clear that, I think we're going to see this thing go to $85 to $90 per share over the course of next couple months. So that's Edward Life Sciences. Next one is a fund, which is Cedar Fair. Now, Cedar Fair owns a bunch of parks all around the country, but most of them are focused in Ohio, particularly their popular one. What is slipping from my name right now? The one with all the crazy rides and everything. And so Ohio yesterday announced that it's going to be reopening also much earlier than expected. They were expected to open all of these amusement parks, casinos, and all of that sometime by middle of July. And now they're going to be reopen everything starting from June 19. That's much earlier than expected. And also they're going to be opening the Memorial Golf Tournament and a whole bunch of other public tours, spots around the middle of July. So basically everything is expected to be back online in the matter of next couple of weeks. But right now what's happening is that we have seen some of these areas that have started to open with extremely positive response on their stock. So for example, you saw when I mentioned repeatedly that Wynn Resorts, as well as MGM, as well as Las Vegas Sands, they were all set up for a sharp breakout because Las Vegas was opening on June 4th, which was last week. So you saw the remarkable rally we had in Wynn Resorts. I traded call options in this one, although I took profits a bit too early. I got long call options in Wynn Resorts right around $89 per share when the trigger went off on my screen, and I closed them around $97, $98 per share. But then by yesterday, the stock was trading at 108, completing this gap that I had highlighted in the charts. But the important message over here is look at the response to some of these stocks as they start to reopen. You saw the same thing with airlines. So yesterday, Avo discussed that how the TSA checkpoint throughput on a daily basis has now gone above 400,000 passengers per day, which was the highest level since March 22nd. And so leading into that, you saw continuously the same thing with a lot of these airlines with very, very strong responses in their charts. Spirit Airlines, United Airlines, Southwest Airlines, all these things were discussed. Well, keep an eye on your on this stock, Cedar Fair symbol fund, because next week is June 19, I believe. And yes, next week. And so when these Ohio parks, where the company gets about 40 to 50% of its revenues from, Cedar Point is the name of that park, the big one. When they start to reopen, there's a chance this thing is going to continue to power higher. It may get to $45 to $50 per share. And while I'm at this, I might as well just discuss some real quick takes on Tesla. You know, there's just a remarkable amount of nonstop news on this stock that just doesn't seem to want to stop. All positive news. So I'm going to give you a couple quick takeaways here. because Tesla continues to break out, had another powerful rally yesterday. It's going to open slightly flattish this morning. According to the Telegraph that came out, I believe 2 days ago over the weekend, the UK government is considering a scrappage program to boost EV sales. UK government is considering giving £6,000 to swap gas or diesel cars for an electric vehicle, which is naturally positive for electric vehicle sellers. Though the focus on the electric vehicle doesn't address sluggish auto demand because we are in a slowing economy. Similar to stimulus measures by France, Germany are also focused on the electric vehicles. So basically, if you live in the UK and you have some old car that runs on internal combustion engine, you can swap that, get an electric vehicle, whether it's made by Tesla or anybody, and get a £6,000 rebate. This was announced by the UK government over the weekend. And at the same time, over in Germany, according to Reuters, Germany is going to raise its climate surcharge on motor vehicle tax for new cars from 2021. That is also very bullish for the electric car makers. The buyers of cars with carbon dioxide emissions 95 to 195 gram per kilometer will pay €2 per gram in a brand new climate surcharge. And cars above 195 gram per kilometer will pay £4 per gram, and no extra surcharge for cars below 95 G per kilometers though. So what this means, and this new tax that they're imposing on the carbon in Germany is going to stay in place all the way through 2030. So this is yet another way in Germany to discourage people from buying the internal combustion engines as well. These were the two major important news that came out in the last 24 to 48 hours, one from UK and one from Germany. And that's why the stock had a phenomenal breakout. Not to forget the simple fact that Tesla also announced its Model 3 May 2020 wholesales, which were better than expected. They sold 11,100 Model 3s in China in the month of May, which was well ahead of 3,600 they sold in April, and also well ahead of the consensus view of 10,200. So there were three pieces of very important news in Tesla. All of those, excuse me, all of those resulted in a sharp spike in the stock, and chart is looking good. It looks like it's going to go to 1,000 at least, and then we'll see where it goes from there. Sorry about that. Okay, that's a lot of coverage from me, but that's it. Avo, what do you have?
I was just browsing around as you were talking about Tesla. Now, I don't know how recent this is, but apparently I don't know, this Baron Capital. Anyway, speaking on CNBC, saying that Tesla will be at $2,000 to $3,000 in 5 years. And that was just happening as you were talking, or earlier at about 8 o'clock or so.
Yeah, he's a billionaire. He came out and he was defending Tesla, and he was saying that, look, if you look at the whole picture and the fundamental changes that are taking place in the electric car makers, he basically said this could double or triple from here, even from here over the course of long term. I heard that conversation a little bit.
Okay, all right, good. I don't have anything new to bring. I just wanted to point out that Clearwater that I had mentioned yesterday morning had a 17% up day yesterday. And I did spot some more call buying during the day. There was buyers of 2,000 July 40 calls and 1,000 October 45 calls, which are now both in open interest according to my trustworthy RBC capital platform. And there was just some, where is it? Hang on. There was an update that the company brought out yesterday, so this would have been why it went up so much. They raised their 2Q EBITDA view from 45 million, 55 million, up to 71 to 77 million. And yeah, that's quite a bump. I guess they're seeing a lot of demand in their products. Otherwise, I would say that the markets are quite extended and especially the internals, as you talked about a couple of days ago, Fahad.
Yeah.
Or Friday it was rather. We'll have FOMC tomorrow. Whether it'll be affecting the market at all as it usually or it has done so in the past, I don't know. But I'm just I think there might be a warrant, not a warrant, but just
Look,
cautionary, just for a pause or something around here.
In terms of market internals being overbought, it's right there in everyone's in front of everybody. I've been sharing those charts in Telegram and chat rooms all the time. 97% of the stocks are trading above their 50-day. NIMO is at 112 plus 112 as of yesterday. The CBOE equity put over call ratio, the 10-day moving average of that is now at 0.47, which I believe is the lowest I've ever seen and that is the lowest I've ever seen in 16 years. So basically every market internals is just so far stretched out. The ideal condition for S&P, just in my high level view, would be a retest of 3,000. So basically we go down from 3,200 to 3,000 on a low volume, summer low volume pullback, and then set up for potential cup and handle formation, large cup and handle, and then do some basing formation around 3,000, spend some time, maybe a month there, just consolidating, build some fresh bases and powers. And then potentially, if the economic recovery is for real, then sometime come August or September, we start to take a next leg higher, and then we have a Santa Claus rally into year end. That will be the most ideal condition, but there's nothing ideal about the economy at this time. 13% unemployment rate if I go by the government numbers, although my personal number is 19% because they fudged the data in my view. But anyways, so that's what we believe, what I think should happen, but not going to bet on this. I'm going to just trade whatever the price in front of me and then go from there. All right, Chronicle, you have IBM you want to discuss?
Yeah, so with correlations really high lately and basically every stock behaving the same way and going up, I think at some point we're probably going to see some decoupling where some stocks continue to go higher while others start to struggle. So I've been looking at filtering some stocks that may begin to underperform soon, which even if we don't want to short them outright, we still want to at least avoid buying them at current levels. Specifically, I'm talking about stocks where the long-term bottom-up fundamentals haven't really improved while the shares have rallied sharply anyway. One such company is IBM. To be clear, I'm not short right now, but if we look at the technical chart I shared, I do think there is a short setup developing as price continues to approach the long-term downward trend line. Keep in mind, this is a weekly chart, so it could still take several weeks to get to that trend line, but this is one we can put on our short list to watch closely. So let's take a look at the fundamentals. To get straight to the point, nothing's improved the past couple months in terms of where IBM is headed over the long term. If we look at their revenues over the last several years, it's been in a downward trend. And in 2019, it was down another 3%. Going forward, I don't think the trend will reverse anytime soon. Because first off, if we look at every solution that IBM offers outside of cloud, they've pretty much fallen behind their competitors. So looking at business services, tech services, and their system segment, it's not an exaggeration to say that they're third or even fourth best in the industry now for all of those segments. And meanwhile, the company keeps talking up the prospects of Red Hat, which, by the way, the current new CEO was the one responsible for with regards to overpaying for the acquisition. They paid $34 billion for Red Hat, which when I look at the profitability of that cloud segment, it looks like they're going to have to keep the same growth rate for at least 8 more years in order to make back that money. Because the company's profitability is low, like pre-tax margin was 13.2% in 2019, down from 14.3% the previous year. So profitability is going down, not just revenue. And I think this is because of how competitive the cloud space has become. And to be frank, management hasn't really demonstrated any strong ability to invest in its own solutions. It's well known and well documented that IBM's culture tends to be pretty stuck in the past, And I don't have much confidence that they know how to innovate and invest in their Red Hat solution and multi-cloud solution to be competitive in the long run. Like, for example, both Microsoft and Amazon have already been encroaching on IBM's territory by pivoting towards large-scale projects for mega corporations and big government projects. So that's the revenue side of things. Meanwhile, on the earnings side, the company has managed to keep its EPS steady the last several years because of a lot of cost cutting and layoffs, plus financial engineering and buybacks. But at the same time, they can't keep doing that. And this is not a sign of a growing company. Last month, they announced yet another round of job cuts that are going to affect another several thousand jobs. And the company's workforce is now the smallest it's been in over 11 years. And I don't think they're going to be hiring anytime soon. So it's really a death by 1,000 self-inflicted cuts here. And when it gets to the point where there's nothing left to throw out, I think the earnings trend will begin to follow the path of the revenues.
Yeah, I agree with a lot of that. As you know, and I'm already short IBM. It hasn't worked yet, but I continue to look at this company as one that's going to have a very, very difficult time being able to take any kind of commanding leadership during a downturn. Because when you actually really simply just take their product portfolio, you tear it apart, and you look at what their end customers are and what are the target markets they have, it just seems like it's just continued to get lost in the dust while everybody else continues to move forward. The cloud piece is not huge. The security piece that they have, even a turd like Cisco Systems was able to do better than IBM, so that's not doing well. Then they have the whole AI built around Watson, which is promising, no question about that, but it's such a small piece of pie, and looks like the traction in this one is also quite slow. And then there's all this legacy business, which is just nonstop doing just terribly. And in a downturn, when IT budgets are getting cut, it's difficult to say exactly how the overall this could be positive for the company. And it's laden with debt. That Red Hat acquisition was done with large sums of debt, so that's something also to keep in mind. I agree with all of that. And I do believe that the earnings will go deeper negative in the coming quarters, and free cash flow will be much more affected than people realize. So we'll see exactly how this thing performs. So you're looking for a move up to 140, 142, and then after that, a prolonged downturn from that point on.
Yep, pretty much.
Okay, good stuff. Jay, what's up?
Yep, what's going on? Okay, so three stocks today. Very quickly, Synaptics. Now you already recommended taking profits in Friday's trading session, but at the same time, you did highlight some weekly call buyers of the 71.5 calls. BMO has a preview note today as the company is hosting a investor day, the first one since 2017. So if someone does still have a position, just note that there is an event happening today. Number two, Mercado Libre. Let me actually quickly send you a chart. So B of A is going street high today to 1,100 from 800. Just last month, JP Morgan went to 1,000, and then most recently UBS went to 1,040. Now, if I look at B of A's note, they say that e-commerce tracking services are indicating sharp acceleration in growth across Latin American markets.
Wow, take a look at this, man. Are you 126% in Brazil in month of just May alone? Argentina over 100% as well. This is awesome. I've longed this stock for a long time, but go ahead.
And I guess one of the other quotes from B of A that catches my attention is them saying, while relatively small in terms of incremental items, we estimate that the addition of shelf-stable consumable categories to MELI's assortments more than doubles its total addressable market.
Wow, this is incredible. The transaction volume growth over 300%. I mean, we discussed this, and I because the same exact kind of e-commerce penetration trends emerged in China and the United States as well during shutdown period, where people simply flocked more and more online. So it increased the penetration. It accelerated the penetration of e-commerce much faster. Looks like this is happening even on a bigger scale than I thought in Latin American markets. All right, great stuff.
And then quickly, the last stock is Shockwave Medical. This was actually brought up yesterday by a client, and B of A has a note today highlighting that yesterday the CMS issued new codes for shockwave procedures performed in both the hospital outpatient and inpatient settings. These codes, outpatient and inpatient, will go into effect on July 1st and then October 1st, respectively. Basically, and B of A goes on to say, given the high cost of the shockwave system, B of A believes payment rates could increase meaningfully within a year or two, which gives them confidence that shockwave will be able to realize a high penetration of the $5 billion total addressable market.
This thing is going to break out today. I mean, it's closed at 45. It's already bid at 47 plus in pre-market. This is a major wall of resistance that I showed in chart and chat room yesterday when somebody asked about this. And also, if you layer on top of this Bollinger Bands, you'll find out how extremely tight they are. And so this has been a setup for a breakout, and looks like that power candle we have been waiting for is going to happen today. Interesting one, because so July 1st is when these J codes go into effect, and that tells me that there's a good reason to believe that for the next earnings report, the company will potentially increase its Q3 guidance or full year second half guidance. Market's going to start to sniff into that. Good one. This might be even worth chasing because of the tight Bollinger Bands. When you start to break out through a major wall of resistance like this, even if it opens at 47, this could run to 50 to 55 rather very quickly because of the technical setup that we have in front of us. Good one. Okay, thank you everybody for joining. Great stuff. Let's stop over here. This is one of the longer versions that we have done of conversations, 27 minutes and counting. I'll see you guys in the chat room shortly.